From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, the U.S. launches fresh retaliatory strikes against Iran for a second straight day, reigniting geopolitical and inflation fears. Now, this comes as Federal Reserve meeting minutes reveal several members have interest rate hikes on the table, and signs of waning demand for AI debt emerge from Amazon's latest mega bond offering. We begin with the big issue, an economy facing ongoing conflict in the Middle East.
Events in the Middle East really were a big shift in terms of the Fed's thinking.
We're still on a knife's edge in terms of creating a loss of inventories that would create a price spike ahead in oil.
The longer energy prices stay elevated, the more that price pressure broadens out into the economy.
The economy is still strong, but higher yields are a headwind.
We think rates are lower ultimately, particularly at the back end.
That whole hawkish narrative was too much narrative, not enough backed by the data.
The market is still pricing a rate hike.
I'm not as convinced that a hike is coming.
We don't think the Fed's going to move this year.
All bets could be off here depending on what happens with the Middle East.
It's really about the inflation data.
We will have a period of some pretty strange inflation data over the summer.
Well, that brings us to our chart of the week, and it's two-year Treasury yields climbing towards the highest levels of the year amid a global sell-off in bond markets as rising oil prices rekindle worries about inflation. Two-year Treasury yields currently trading near 4.17%. The one-year chart particularly startling, though I will remind viewers that we were above 5% and then some back in 2023, but really since March it has been kind of a steady climb higher. Now, the spike in yields sparked by these words from President Donald Trump on the status of the ceasefire between the U.S. and Iran.
To me, I think it's over. I don't want to deal with them and with their scum. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. We just hit them very hard, and every time they hit us, we're going to hit them 20. And when they hit, we hit back much harder.
Bloomberg's international economics and policy correspondent Mike McKee, he joins us now for more with the chart in hand. And Mike, of course, higher oil prices certainly not helping the inflationary outlook here, but energy alone isn't the full story.
No, and it hasn't been the full story for the Fed. They've been watching other parts of the economy, particularly in service industry areas that we've seen sticky prices. Now, part of that is because of energy, but airline fares, for example, have been something that have been staying up. Also, insurance costs. So one of the things the Fed is looking at very closely is the so-called, remember this one, Katie, supercore inflation, which is basically services ex housing, since the housing market is in a kind of a weird situation. And you can see that the prices have been going up over the last 3-4 months, ever since the war started. And the Fed is going to want to see that come down before it decides that maybe they can make any other kind of moves. If it continues to go up, then you get an increase in the likelihood of a rate increase.
Yeah, and I mean, lay that together with what we're seeing in the labor market, though, because those two sides of the dual mandate seem in tension. What we're seeing when it comes to inflation, when you break it down by those different measures, but then you think about the jobs report that we got actually a week ago today, maybe reigniting a little bit of concern about the labor market, which, you know, hasn't really been at the forefront of investors' minds.
The Fed has been very sanguine about the labor market because job growth has been reasonable and the unemployment rate stays low. And at this point, the unemployment rate's even lower than it was at the time of the meeting, not necessarily for the best reasons, but it is at that level. And job growth was reasonable. It was enough to, it was at the neutral level for job growth, enough to keep the unemployment rate from rising. So at this point, the job market is hanging in there. They don't have to particularly worry about that. So that kind of takes the pressure for a rate cut off the table. It's inflation that worries them at this point, and the idea that gasoline prices might start going up again isn't good news, because that affects consumer expectations, and then you have problems in the economy. So much more for the Fed to worry about today than at the time the minutes were written. Back on June 17th was the day that they signed that memorandum of understanding that everybody thought might bring the war to an end.
All right, Mike McKee, great to get some time with you, joining us from an undisclosed Bloomberg location. That is our own Michael McKee. Let's dig into all of this and more with our roundtable. Subadra Rajappa, head of research over at SocGen, as well as Bhansali, founder of Longtail Alpha. Great to have you both with me. And Subadra, I'll start with you because it feels like this week was a big reminder that geopolitical risk is still real, and it reasserted itself back in these markets. And I wonder how you're thinking about energy. As we were just discussing with Mike, it's not the entire story when it comes to inflation expectations, but again, it certainly doesn't help.
Yeah, definitely higher energy prices, higher oil prices has led to higher inflation expectations. And it's almost restarted this rout in global bond yields, if you will, with gilt yields, bond yields, as well as JGB yields rising in tandem. So geopolitics is definitely a very important factor in the price action in the bonds over the last week. And, add to that concerns about debt and deficits. I mean, that's something that's, again, back in the forefront. You discussed, the issuance coming from some of the hyperscalers. So in aggregate, you're looking at a lot of bond supply that the market has to absorb, and that's also pushing bond yields higher.
Yeah, and Subadra, I mean, just to finish that thought, I think that's a really interesting dynamic, the fact that, you have bonds dealing with all these different fundamental issues right now. And then at the same time, you have the technicals, which is in the form of massive corporate supply. And I wonder if that's, sort of crowding out some of these Treasury investments.
We had Treasury issuance as well this week. So yes, in aggregate, you're starting to see some level of concession that's built into the Treasury market. And that's what investors are demanding to take down the supply. The supply in general has been well absorbed, but you're getting a lot of supply coming from on the corporate sector. You're starting to see concerns about maybe a bit of a pushback in global bond yields. And that all kind of adds to the pressure that you're seeing in the bond complex. So it's a variety of factors that I think are pushing bond yields higher. Inflation expectations, as I mentioned earlier, is also pushing bond yields higher. Real yields are moving higher. The yield curve is starting to steepen out a bit. So this sort of move that we've seen in the last week is more of a bear steepener. And that is something that is a little bit of a change in the dynamic that we've seen, given the fact that in recent weeks, we've seen the curve somewhat flatten, and you're seeing some of that flattening unwinding.
Yeah, absolutely. And Veneer, I want to bring you into the conversation here, and just to start on the inflationary backdrop here, you think about some of the supply shocks coming through in the energy market. I mean, does the Fed have the tools to actually address what could potentially be going on when it comes to price pressures? Or, do they sort of lose their potency when you think about some of the factors we're dealing with right now?
Yeah, I think that's the big question. And to me, it is the question that should be on everybody's mind. I think over the last few years, maybe a decade, the Fed has pretty much lost control of the economy. I think they're doing a lot of things. They're obviously, moving short rates. Used to do forward guidance. That's now gone the way of the task force. So a lot of changes have happened. I think they largely do not have the tools, and the fact that their credibility and the fact that their record of forecasting inflation and controlling has been quite dismal over the last 5 years tells you that the market actually does not pay attention. So I come from a trading type of background, and I can tell you that, of course, in the short run, when they do something or say something, we all pay attention. Like a couple of weeks ago, when Mr. Warsh talked about inflation, and everybody was expecting him to talk about in a more dovish way. But largely speaking, the market ignores it. And I think they actually do not have the tools. They are pretty much cornered at this point of time.
So, Veneer, how do you trade around that? Is the idea that, the Fed, in your words, is losing control of the economy? I mean, is that an investable thesis?
Absolutely. I think what's happening, and you have to kind of step back a second and not just think tactically in terms of the most recent data on inflation and labor and all those things. And you have to look back and say how we got to this point, right? So if you look back the last 20 or 30 years, we had the 2000 crash, and then we had the 2008 event, and then incredible amount of money printing that happened, and credibility got lost that had been earned for a long period of time. And so now you're at a point, and of course, in Europe and in Japan and other places, we had 28 trillion of negatively yielding bonds, right? Remember that? And then inflation surged and all this money printing happened. And now we're at this point. So it's like a slow motion train wreck. And you are now, sitting at a point where they've lost all the bullets, so to speak. And the market is saying, and that you can see obviously in terms of old strategies performing again, bond arbitrage strategies, momentum strategies, and so on, despite the recent pullback. So what you basically are in a world where investors are a little bit back in charge. So the way you trade it is by old-fashioned looking at value, right? In the 2010 to 2012 or 15 was a pretty massive distortion in financial markets because the central banks were basically controlling asset prices, and that didn't work very well. So now you're back to the way markets are supposed to behave, which is, large moves and bad risk gets penalized, good risk gets rewarded. And, we can talk about it more later. We are seeing pretty significant signs of this evolution ending in what we call a regime shift.
Right.
I think we are undergoing a pretty substantial change in conditions, and the markets of the next 10 years will look very different.
Well, Subadra, I'm curious to hear your thoughts here, because, again, you think about the backdrop that we're in right now. You have the Fed with their dual mandate seemingly in conflict. You have Treasury yields near their highs of the year, a global bond sell-off. What is the playbook that you're using right now?
So I think Vinay pointed out some really interesting points. I mean, the trajectory for debt and deficits is something that is a big concern. Overall, our base case is that the Fed keeps policy on hold, for the remainder of this year and perhaps well into next year, and that would probably mean range-bound to even lower, bond yields in the long end. Of course, that is very much dependent on what happens on the geopolitical front. It's also very much dependent on how the market reacts to the trajectory for debt and deficits. So far, the markets have mostly ignored the trajectory for debt and deficits, but that could gradually start to come in the forefront. But I think for our base case over the near term, at least for the remainder of the year, we think that yields probably remain range bound in the very long end. I just don't see a clear path towards a significant steepening of the yield curve from here on.
All right. Unfortunately, guys, we have to leave it there. Really enjoyed this conversation. Our thanks to Subadra Rajappa of SocGen, as well as Bhansali of Longtail Alpha. Now, still ahead, global return, pricey credit markets fueling go-anywhere funds, and they're beating the overall credit market. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for global return, looking at bond returns worldwide. Bond investors increasingly betting on flexible funds that can buy whatever they like. The size of unconstrained funds growing by 6% here in the U.S. and by nearly 10% in Europe. Tassos Vassos is covering the story for Bloomberg News. I'm pleased to say that he joins us now. So, Tassos, first off, give us the lay of the land here. When it comes to these go-anywhere funds, what exactly are they, and why now are they seeing this uptake?
Well, the reason they're seeing it now is because the credit market is particularly expensive. If somebody goes and checks a chart of credit spreads, they're going to see them being near the lowest level since the chart actually goes all the way to the 90s. So a portfolio manager sees that and says, well, everything is extremely expensive now. The reward is not there too much. At the same time, though, there's a lot of potential downside that you can see. We had it yesterday, for example. Volatility spiked up after President Trump, for example, made certain comments. And a number of people said, well, the risk reward is very skewed here. I can make a lot right now in the credit market if I just buy an index, but I can actually lose quite a bit.
Well, talk to us a little bit about those index strategies, because a conversation, that I've been having a lot recently is that as you see all of this massive issuance from some of these tech giants, that concentration risks are growing. So, the growth that we're seeing in these go-anywhere funds, does that partly link back to, what we're seeing when it comes to passive credit strategies and these fears of crowding?
very much so. And we haven't seen anything like that historically. The level of crowding that we see in the credit market now is, one could argue, unprecedented. $25 billion of deals. That used to be once in a blue moon situation, and these days we just see it almost every second month. So yeah, for a number of portfolio managers, what they see is a lot of concentration risk. Not just the fact that they have to buy even more of these things, but as all of the portfolio managers go at the same target at the same time, the price of these ones actually gets inflated. So there's a number of debt and risk that's being added, in particular because of AI, and that's a very big reason why investors try to avoid a lot of passive investments these time and just go with these portfolio managers who can actually look at pretty much everything out there.
Absolutely. Well, it's a fascinating story, a fascinating trend. Really appreciate you joining us. That is Bloomberg's Tassos Vassos. Now, still ahead, we're going to dig deeper into credit with our Credit Roundtable. We'll be joined by Gretchen Lamb. She is the CEO of Octagon Credit Investors, as well as Zachary Griffiths. He is the head of U.S. IG and macro strategy over at CreditSights. This is Real Yield on Bloomberg. All right, it's time now for a moment of interest. Energy drink maker Celsius, Skechers, and other junk-rated companies are seizing on hot credit markets to secure better terms from lenders. Now, the move is sharply reducing the extra yield their loans offer compared to benchmark borrowing costs. And I'm pleased to say that Bloomberg's Aaron Weinman joins us now for more. So, Aaron, talk to us about why this is happening now. I mean, you could make the case that credit markets has been hot. They've been hot for a while now. So why are we seeing this sort of rush to reprice right now?
So there's multiple factors at play here, Katie, but at the heart of the matter is that there is very little what they call new money in the market, and what that primarily means is money that's being supported by mergers and acquisitions. So because that little new money flow is coming through, or not coming through, I should say, that's leaving investors very little choice but to continue to play in the existing loans they hold. And when, against the backdrop of very strong credit markets, the better credits or the better companies or borrowers, whatever you'd like to call them, are in a position where they can lower their borrowing costs and reprice their loans by 25 or even 50 basis points in some instances.
I mean, it's interesting because hearing you talk, it almost sounds like lowering borrowing costs. That's very nice. I can understand why that's attractive, but it's not the whole story here.
No, not at all. So the reason why they can lower their borrowing costs so much is not just because there's lack of other opportunities to invest in, but they have a lot of money, the investors have a lot of money that they need to put to work. Primarily what that means is the CLO buyer, which is the largest buyer of a leveraged loan, has a lot of vehicles that they have stocked or warehoused, to use their terms, and that money needs to find a home. In the case where there's very little new money opportunities like dividends or acquisition-related financings, repricings is another option that they have. It's not the most lucrative because it means that their coupon's getting clipped, but for the borrower, it means that they can lower their interest payments every quarter.
Interesting. And I mean, not that you would expect perfect harmony here, but it sounds like that's a little bit of tension here between the investors and I would imagine the banks as well, and the firms and their owners who are actually doing these repricings.
There is a little bit of tension in the sense that obviously the bankers and the investors are not making the kind of money that they would usually make, right? So for an investor, a higher coupon means they get more money for their vehicles and their underlying investors. And for the banks, these repricings don't generate the kind of fees that they would typically generate if they are financing or underwriting an acquisition or paying a dividend. Those deals are far more lucrative, their fees are higher, and as you know, this is Wall Street, everyone wants to make a bit more money, and repricings are not the most lucrative form of leverage finance, to put it lightly.
And what's the expectation here? I mean, could we see more of this activity pick up when it comes to M&A and some of the other activities that can go on? Or is the expectation here is that, this wave of repricings that we're seeing, these refinancings, is going to continue?
The general consensus is that's the latter. So there's a lot of refinancings that need to occur between now and 2028. So there's debt that needs to be not only repriced, but also refinanced, perhaps in the bond or the loan market. as far as M&A is concerned, it's to be determined whether that's going to pick up. The consensus view is that it's expected to, but there's still some laggards in the background, such as private equity and the valuations of their own portfolio companies.
All right, Aaron, really great reporting. Appreciate you taking the time for us here on Real Yield. That is Bloomberg's Aaron Weinman. Meanwhile, let's get a check on these markets right now on this Thursday, of course, a couple of hours into the trading day. You're taking a look at the Treasury market right now, and you can see that there was a rally. You know, we switched away from the Treasury market, but I did think it was interesting. You're also seeing a rally when it comes to the equity market as well. The S&P 500 higher by about 0.7%. The strength coming through when it comes to the NASDAQ 100, a rebound in the chip makers leading that tech-heavy benchmark higher by about 1.5%. But it's not just the big guys, it's the little guys too. Take a look at the Russell 2000, higher by about 1.2% at the moment. I have to imagine that that drop in yields that we showed for about 4 seconds helping with those small stocks. But coming up next, it's the auction block. This week's Amazon mega deal extends a historic pace for debt issuance as the AI boom rolls on. We're talking credit next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield, and we do have some breaking news crossing the Bloomberg terminal at the moment, and it's interesting. Anthropic appointing former Fed Chair Ben Bernanke to oversight trust here. He is the fourth member of the AI firm's long-term benefit trust. Again, I'll read that headline once more, that Anthropic, the AI company, as you know it, is appointing former Fed Chair Ben Bernanke to its oversight trust. Let's try to get a little bit more context here with Ed Ludlow, who I'm delighted to say is joining us on set in New York. So, Ed, talk us through what we know so far. Why is a former Fed chair joining Anthropic?
Because in the first instance, Anthropic and its co-founders are very conscious of the potential economic impact that AI will have. They could not be more clear about that in the statement. The way that this runs as a public benefit corp is, instead of handing all over power to shareholders, even of a private company, the long-term benefit trust essentially gets to have board oversight. It can appoint directors, it can control the mechanics of that board composition, and with time has a power to add more, which Anthropic says it will do. And so, reflecting not just on Bernanke's position as a former chair of the Federal Reserve, but also his work in academia, looking at the economic history of the Great Depression and disruptive cycles in the history of the US economy, they're basically saying this is the perfect person to join this long-term benefit trust and help shape the oversight, because the way that Anthropic structured is you can have a dual purpose. Yes, AI for profit, but also to serve the long-term contribution and value of humanity. And that's sort of Anthropic's guiding principle.
Well, you're touching on what I was wondering, and that is, what does Ben Bernanke, with that impressive resume that he has, bring to Anthropic? Tell us a little bit more about this role, you know, what his responsibilities will be, what he actually has the ability to do.
Well, more specifically than just saying the economy, one thing that Anthropic cites is workforce, so labor economics. You know, that is something that we've written endlessly about, particularly in the realm of physical AI, right? Where do humanoid robotics come into industrial sectors, agriculture, etc.? And the word that Anthropic leans on in Bernanke's case is judgment. You know, the board has others on it, Neil Buddy Shah, Richard Fontaine, Mariano Florentino Quellar, and they will add more in time. But it is very much focused on this idea that AI is going to change not just output from an economic perspective, but how the economy works. And I would put a lot of emphasis on the labor force as a part of that.
All right, Ed Ludlow, so appreciate you rushing to set here. That is Bloomberg Tech anchor Ed Ludlow joining us on that really interesting news item that former Fed Chair Ben Bernanke is joining Anthropic's oversight trust. But let's get back to these credit markets, because it's time now for the auction block, where we highlight the major credit issuance so far this week. And this week, of course, it was all about that Amazon $25 billion sale. Its leading weekly issuance so far to nearly $50 billion, surpassing the highest dealer forecasts. Now, despite its size, it was met with a little bit of a chilly reception. Demand settled at about 1.6 times the deal size. That's in comparison to the average of around 4 times for most deals. Now, the Amazon deal is part of a global borrowing spree by the company. It's passed $100 billion across different currencies to fund its AI plans. It's expected to spend almost $200 billion this year. And debt offerings around $25 billion or more have quickly shifted into a baseline for tech giants funding their AI expansion. Amazon's sale marks the 7th time this year alone that a tech company has reached that mark. Now, that's more than the total number of big sales in the previous 6 years combined. Now, sticking with credit, some investors still see demand for AI debt.
Money is still very cheap for these AI hyperscalers. Again, to give them a lot of credit, over the last 10 years, they've built fortresses of balance sheets. So they will have much more demand than the US Treasury for the long end debt at the moment. But the compensation will keep pushing up as debt holders like us, who are more spread-based buyers, almost run over by yield-based buyers over the last 1 year, are going to keep pushing back in terms of how much we will need in total return type portfolios rather than yield-based portfolios that we manage. A lot of it then depends on the robustness or the durability of AI overall.
Well, let's dig into all of this with our credit roundtable. Gretchen Lamb, she is Chief Executive Officer over at Octagon Credit Investors, as well as Zach Griffiths, Head of U.S. IG and Macro Strategy at CreditSights, joining me now. And Zach, I want to start with you, and I want to start with that Amazon bond sale because, that, of course, is the talk of the town this week. The fact that it was still oversubscribed, but maybe less so than we have become accustomed to. And I wonder, if there's anything to extrapolate out from there, in your view, about demand for some of this massive tech issuance that we're seeing.
It's interesting, Katie. If you go back to March, Amazon had a deal back then that was also met with a less rosy demand backdrop with higher new issue concessions, lower coverage of the bond offering. And so we're seeing that again today. I don't know that we can extrapolate it too far, but you do have to wonder just how much more of this issuance investors are willing to take or at what price. And so seeing the smaller order book, seeing new issue concessions around 15 to 20 basis points, that indicates either concern about the overall amount of supply coming to market or concerns with Amazon. We still like Amazon as a credit, as our analyst has an outperform on it. So we see these higher new issue concessions as a buying opportunity.
And I want to talk about, Zach, a little bit about how basically you see this being absorbed. Because as you mentioned, you're starting to see some concessions, but there was a really interesting story on the terminal this week. Traders dumping tech bonds to make room for Amazon debt deal. And I mean, this extends outside of Amazon. So you think about all the tech issuance that we're seeing so far, how much churn is that causing at the portfolio level?
I think you're definitely seeing that, Katie, and part of that is applying to sort of what you're seeing in the Treasury market, I think, in terms of having to make room for these deals coming to market. We've printed over $1.2 trillion in the U.S. IG market so far this year, and at times that you've seen sell-offs in the Treasury market, part of that seems to be coming from all of these deals coming to market on the IG side. And so does seem to be a competition for capital, but at the end of the day, we remain comfortable with the technical backdrop as we still see a ton of cash in money market mutual funds. Doesn't necessarily mean it has to come out of there, but the amount of interest those funds are generating, that is likely being recycled into the market and creates a technical tailwind that we think has been stronger so far this year than we had anticipated and can continue into 2027.
And Gretchen, I want to get your perspective here, on the broader tech universe, especially when it comes to CLOs. I mean, I think of Octagon and I think of CLOs, and you think about the state of that market right now. How much pressure are you seeing coming from software loans, which were certainly a worry spot earlier this year?
Certainly, we continue to see weakness and the anticipation of weakness within the sector. But within the CLO market, within the broadly syndicated loan market, we are seeing a less overall exposure to the sector than in other markets, like in the direct lending market, for instance. So while the overall impact on the CLO market, I think, is manageable, if you were to just look at software loans within the broadly syndicated loan market, what you would see is that as of the end of June, those loans were trading at a discount margin of over 800 basis points over SOFR. Those are levels that are higher even than those loans were trading at during March of 2020. So the market is telling you that it's worried. And this is a fate worse than COVID. I think ultimately we'll have to see whether the market's fear and the indications as to where those loans are pricing was justified or not.
And outside of just software, Gretchen, I want to get your thoughts also on a story we were discussing with a reporter earlier in the firm in the show, that you think about all these different junk firms that are out there right now. They're basically using this moment in time to reprice their loans in a big way. We've certainly seen that pick up, not just in the U.S., but in Europe as well. And I wonder what effect that's having when it comes to, potential losses from the investor standpoint, because as I understand it, it's great for firms.
Yeah, what we're seeing in private credit is that the technical has shifted, where the demand is not as robust as it had been, and that's resulting in new direct lending loans coming to market at a slightly wider spread and more attractive covenants and more attractive structures for lenders.
Mm-hmm. And Zach, to swing this question to you, I follow ETFs really closely, and CLO ETFs in particular have been on fire, especially when you take a look at their demand relative to some other types of fixed income funds. And I wonder whether you bring together all these different cross currents right now, whether you see that cooling at any point.
Not really, Katie. And when I think about some of those drivers and the leveraged loan market, what's attractive about it right now, that floating rate exposure, now that markets have shifted to expect yields to remain high for longer, I'd say that's a tailwind for floating rate versus fixed rate. Now, if you move down the credit structure or the rating structure, that's a bit of a challenge for some credits that needed lower borrowing costs to sort of weather this environment. And when you think about the best of both worlds, if you want to buy high quality CLOs, you get that floating rate exposure and you can avoid the riskiest credits. And so I do think that that could remain an attractive opportunity or an attractive place to put cash going forward, Katie, not just a recent trend, but something that could continue.
And Gretchen, I'll give you the final word here, because I do love that chart that we just showed from Bank of America showing that worldwide CLO ETF assets surpassing $50 billion. Talk to us about how you see that appetite, that demand evolving from here. Yeah,
it's really been a remarkable uptick in the last couple of years, as this chart shows. If you go back to June of 2023, total AUM within that complex was $3.5 billion. So it's been a remarkable growth. I think it's here to stay. I think that CLO ETFs will continue to grow. Most of that AUM is focused on the AAA rated tranche of CLOs. That's over 80% of that 50. And if you were to look at that, call it 40 billion of AAA holdings as a complex, as one holder, that would represent a top 5 holder of CLO AAAs globally. And so this is an investor of consequence, an investor as a whole that will influence certainly the technicals on a go-forward basis. And I think to the extent that we're seeing strong inflows into CLO ETFs or strong outflows, it will definitely move the market, particularly at the AAA tranche.
Yeah, it's a fascinating point. You think about a totally new type of investor being introduced to CLOs in the past couple of years, certainly going to have ramifications for the markets themselves. Guys, unfortunately, we have to leave it there. Really enjoyed the conversation. That is Gretchen Lamb of Octagon Credit Investors, as well as Zach Griffiths of CreditSights. Now, still ahead, Jersey City, it's Hoboken's neighbor. It's facing a fiscal crisis, and their mayor is weighing a plan to sharply increase property taxes that might affect a few folks on Wall Street. That conversation next. This is Real Yield. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for our Muni moment. And after decades of drawing in tens of thousands of new residents as gleaming apartment towers rose near the Hudson River waterfront across from Manhattan, Jersey City has suddenly found itself teetering on the financial brink. Bloomberg's Nick Corello has been reporting on this story. I'm pleased to say he joins us now. So I care a lot about this story, Nick. I live in Hoboken, and this story made me a little bit worried about it. Talk to me about what is going on with Jersey City. How exactly did we get here?
Sure. So Jersey City has a new mayor who took office at the beginning of this year. And about a month after he took office, they released a report that found a $255 million budget deficit. That's about a quarter of their entire operating budget. And they have placed a lot of the blame on the previous administration. Long story short, the reason being they spent a lot of one-time sources of revenue on recurring expenses, which is generally considered kind of an unsustainable budgeting practice, according to the new mayor's kind of budget report.
Mm-hmm. And I will point out that Hoboken also has a new mayor. Shout out Emily Jabor. I won't ask you about that, though. But talk to me about this potential tax hike, because that's what people are really worried about here.
Yes, Jersey City has a bit of an unusual budgeting calendar. So right now they are working on the budget for the calendar year that we're currently in. Maybe in late June, the mayor's office proposed a 20% tax increase to try to get ahead of this deficit. That was met with pretty swift opposition from the residents, sent the mayor's office back to the drawing board. They found about $55 million of cuts originally. They looked for some more, came back with a 15% tax hike, and that was voted down unanimously by the city council. So now the mayor's office is planning to reintroduce 15% as part of a broader budget process, and from then on it's in the city council's hands. But on top of that, they also appealed to the state, who stepped in and gave an aid package to Jersey City. It was about $120 million, which included a $105 million loan. That was the biggest loan the state of New Jersey has ever given to a municipality.
Wow. Well, Nick, really appreciate you following this story for us. It's going to be interesting to see how that 15% proposal goes over. That is Bloomberg's Nick Corello. Now, still ahead, it's our final thought. We're looking ahead to Fed Chair's Kevin Warsh's testimony to Congress next week. Also, a wave of economic data. This is Bloomberg Real Yield. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for my final thought, and that is that June FOMC minutes really emphasize the central bank's commitment to price stability ahead of Fed Chairman Kevin Warsh's Capitol Hill testimony next week. Let's bring in Bloomberg's Enda Curran now for more. And Enda, you could make the case that these testimonies are more about sound bites versus substance, but talk us through what we might be expecting the tone to be coming from Kevin Warsh.
Well, it's going to be all new ground, all new information, Katie. A very rare opportunity for us to hear from new Chairman Warsh in terms of what he's thinking about the economy, what he's thinking about inflation, and how he plans to steer policy over the months and years ahead. We haven't heard that much from him since he became chairman. We had, of course, the press conference. We had the panel, the ECB panel appearance last week, but no major speeches on the like. So lots of economists and Fed watchers want to hear detail on what he's thinking about the major inflection points right now. Where does he see the jobs market? Where does he see the main inflation pressures? And how does he think the Fed will respond? A lot of people talking about the so-called reaction function. What's his reaction function? How will the Fed be responding to these events in the months and the years ahead? So because we don't know too much about his current thinking on monetary policy, all of it's going to be new, all of it's going to be interesting, Katie. And over 2 days, I think there will be a lot to glean from, but a lot of new information coming out of these hearings.
You know, and I mentioned those June Fed minutes, but one of the big variables that's changed is, think about what's happening on the geopolitical front, and the fact that President Donald Trump saying that the ceasefire with Iran is over at this point. I have to imagine that'll come up as well.
It's whiplash on the inflation front. I mean, we had the Iran war, then we had the negotiated ceasefire, oil prices tumbled back, and of course that would take the sting out of headline inflation. Inflation data next week, for example, the headline numbers might even be negative. But now, of course, there's a threat the violence has resumed, and maybe that carries on. That will impact oil prices. So that is a wild card. But it's not just energy. If you listen to the Fed policymakers, we're also talking a lot now about the AI boom and how that's driving up inflation because of the whole demand story there for memory and chips and everything else. So it's energy, it's AI, and a tariff story continue to linger. There's lots to think about on the inflation front in the months ahead.
Yeah, and just in the last 30 seconds or so, it's also, the labor front. You think about what we learned a week ago when it comes to the U.S. economy, that headline jobs figure certainly coming in weaker than expected. So perhaps an update, too, on how the chairman is thinking through some of those labor market dynamics.
Yeah, we had a softer number last week, softer than expected. But on a 3-month average, the jobs market has still been above the so-called break-even rate. I think most economists would describe it as stable. So it will be interesting to hear if Chairman Warsh does deviate from that language.
All right, Enda, really appreciate it. That is Bloomberg's Enda Curran. And that's it for Real Yield. We're going to take you live now to an interview with CVS Health Chairman and CEO David Joyner. He's speaking with Bloomberg host and Carlyle co-founder and co-chairman David Rubenstein at the Economic Club of Washington.